Thanks everyone for being on the call today. So we're Ultimate Products. We are a branded consumer goods business. We supply typically into retail, although we do sell via online platforms as well. And our mission is a beautiful products for every home. So every home, because we want to be at that price point, those price points that the households can afford. And we're a bit counterintuitive. Most branded businesses use their brand equity to increase the price of their products, and in increasing the price of their product, they increase their gross margin, and therefore create the space within that gross margin to spend on marketing their brands. We go the other way. We use our brand equity to drive volume, and we use the productivity in the business in order to create the space to market those brands. So we want to be at price points for every home, on or just above own label. And what we mean by beautiful products is we talk internally about the countertop test. We want our products to pass the countertop test. Now, what does that mean? That means that when you buy our products and you take it home and you put it on your countertop and your friends come round, the product needs to, do you keep the product on the countertop, or do you put it in the cupboard before your friends arrive? If you put it in the cupboard, it's failed the countertop test, and that is product that we don't want to sell. Our brands are, we have a number of brands, typically British heritage, but our two principal brands are Salter, famous for its scales and kitchen. Salter is the UK's oldest housewares brand, dates back to 1760, older than the United States of America. And as we say to our French colleagues these days, founded before the French Revolution. Our other principal brand is Beldray, which is well known for its laundry and floor care. Beldray dates back to it is over 150 years old, dates back to the 1870s. Another beautiful British heritage brand. And between those two brands, we already feature in 80% of UK households. I'm often, people will say to me, I've never heard of your product, and I'll often get a call back the next day where they say, actually, I went back home, I checked with my partner, and we've got a couple of your products in the cupboard, so or indeed on the countertop. What is the investment proposition? Well, we offer four things. We offer an unusual mix of capital growth and income. Capital growth because there are 1.5 billion kitchens in this world. We are still 2/3 UK focused. In the short to medium term, we see the majority of our growth coming from mainland Europe. But in the long term, you know, as I say, the 1.5 billion kitchens globally. Secondly, we combine that with income. We are a capital light model. That means we can grow and pay a dividend along the way. So an unusual combination. The third thing we offer is resilience. We have a very flexible commercial model. As I think we've evidenced in the periods sort of since 2020, we can adapt commercially and operationally to you know, almost whatever external challenges come our way. And finally, we offer a leading approach to ESG. For some people, this is important. Some people less important from an investor perspective. But we use this commercially to sell. We have customers for whom ESG is, retailers for whom ESG is super important, and we can offer a solution to them which helps Simon Showman, our founder and chief commercial officer, sell into those into blue chip retailers. Looking at the presentation here on page 2, compelling customer proposition provides resilience. Established international online presence provides the opportunity for accelerated growth. We're going to talk about this a bit later on. Huge focus on automation and productivity. Really important at the moment, as you know, all of UK PLC has seen and will see escalating wage costs, and as mentioned before, a leading ESG strategy. If you move on to page 3, please, Hannah. So I'm not going to go through this. It's quite a lot on this slide. I'll leave it to you to read at your leisure. On the right-hand side, we have these priorities are our 5 guiding principles that we've had since the end of 2013, when the group pivoted from being a sourcing business to a brand-led business. I'm just going to pick out for the moment execution to have best-in-class execution in everything we do. I mean, this is going to sound really boastful, but if you don't blow your own trumpet, no one else will. So we are the best, we believe, at what we do in the GM space. We believe when you look at all the elements of what we do, we are better than other people, whether it's product development, supply chain, sourcing, product quality, account management, inventory management. We believe we are certainly best in UK and Europe, and certainly up there globally. The one area where we've historically been not as good as our competition, but we are catching up rapidly, is in our approach to branding and marketing. We appointed the brand director a couple of years ago, Tracy Carroll. We've recently rebranded Salter, one of our 2 main brands, and we're in the process of rebranding Beldray. Around that, a significant step up in marketing efforts. So we've been learning a lot over the last couple of years in terms of branding. There's probably still a gap there between us and some of our direct competition, but that gap over the next couple of years that gap is closing, and over the next couple of years will be closed. If you move on to page 4, so Chris is going to go into more detail around the FY24 numbers. I just wanted to make a couple of points on this slide. We did have, really from January 22 to December 23, 2 years of retailer destocking. Now, for us as a B2B business that supplies retail, when retailers are overstocked, it's really tough, because they don't just reduce their orders, they stop their orders, and they wait until their stock is normalized, and then they start ordering again. So for a 2-year period there, it was really quite challenging, because retailers have built up excess stock, bought off the back of really strong COVID demand, and when that COVID demand, when that boom eased, they found they had too much inventory. Stock levels have been clean generally in retail since January this year, so that's behind us. But it did make for a challenging couple of years. In FY23, that was mitigated by the air fryer boom, which was really helpful. But in FY24, when that boom started to come off, we unfortunately did lead to a drop in revenue and a drop in profitability. Nonetheless, we have held our dividends. Under our policy of 50% of profit after tax, there was debate about whether we should stay in line with that policy and reduce the dividends. But we are very confident in our prospects, and for that reason, and also, of course, we have a strong balance sheet, strong cash and debt position. So the board, I think, very sensibly made the decision to hold the dividends for FY24. If you move on to page 5, So I've kind of touched on this a bit earlier. We moved from a sourcing model in 2013 to be focused on rather than selling on product and price. We moved to selling on brand, product, and price with Salter and Beldray at the forefront of that change. We're moving into a different phase now, which is we're not just going to sell on brand, product, and price. We're going to sell on capability, brand, product, and price. You know, I say we've built an immense capability over the last couple of decades through, you know, sort of substantial investments in the business in terms of our systems and processes and automation. And we believe this really sets us apart from our competition. And it's that capability which retailers often need, you know, always needs from their suppliers, particularly the larger retailers. You can see that on page 6. The development over the last 10 years. 10 years ago, half of our revenues came from brands that we owned, and a quarter came from our 2 principal brands. If you actually go back to FY13, the numbers were even lower again. It was only 20% of our revenues came from brands that we owned. Now, you know, 80% of our revenues come from brands that we own, and 60% come from those 2 principal brands. Salter, famous for its scales and kitchen, and Beldray, our laundry and floor care brands. And as you can see on the right hand side, you know, we've been really working hard on those brands over the last 18 months, rebranding Salter, and at the moment sort of partway through the process of rebranding Beldray. Just move on to page 7. I just want to talk about this capability point, because it's the capability that builds strategic relationships with retailers. And I just want to, for those of you who are maybe less familiar with the supply side, you might be more familiar with retail than the supply side of supplying into retail. It is very complex to supply retailers. I don't blame them, but they make it complicated for their suppliers because it makes it simple for them, which is exactly what I would do if I was in their shoes. So I always use a consumer. I always use Ryanair. It's not a retailer, but it's a consumer facing business as an example. If you want to buy a flight off Ryanair and pay by check, well, you can't. They define how you interact with them. And that's the case with many consumer-facing businesses. When you're supplying retailers, they define how you will interact with them. So, for example, you know, a large supermarket retailer that we're very proud to serve has 3 vendor manuals. Each of these vendor manuals may be 100 to 200 pages long, and we have to comply with all of the requirements in those vendor manuals. And those requirements might vary from everything from the ethical process to how high you can stack a pallet. And so huge complexity, particularly when you multiply that across 300 plus retailers, all of whom need to be supplied differently. So we've built a machine to deal with this complexity, and the graphic on the screen is our way of articulating this. At the core, we have a culture of continuous improvement. And this culture is built upon our graduate development scheme. We're highly unusual in our space, both our geographic space in the Northwest and in terms of where we are in the supply chain, in having a graduate development scheme. And it's been in place since 2012. And what that does is it gives us the human capital that has the desire to improve day after day and isn't afraid to point out the bits of what we do that can be either removed or automated. Built upon that foundation, we then look at that generates automation ideas. Our process development team deliver that automation. That delivers increased productivity. About 2/3 of that over recent years has been recycled back into higher salaries. That in turn gives us better quality recruits and so on, and delivers the virtuous circle. Now, of course, the obvious benefits of this is control of OPEX, and also UK PLC is suffering from significant inflation and has done for a number of years now of their salary line. If you look at our results for 24 on OPEX, are roughly level with 23, and I think 25 will be similar again. So we've been able to mitigate these upward pressures on our cost lines through the use of productivity and automation. But really the big deliverables for me are the ones which are perhaps a bit more difficult to directly measure, but are more commercial in nature. It means, for example, that we can invest in branding and marketing despite having super competitive price points. It means we should always be lowest cost, and this is the instruction to the business. When it comes to what we charge our retailers and what our consumers pay, we must be lowest price, spec for spec. If someone's a lower price because it's a poorer spec, can't do much about that. Specs for spec, we've got to be the lowest cost. And if we recycle the benefits of increased productivity and automation into these sort of commercial benefits, then that in turn should deliver more revenue and improve our competitive positioning. If we go to page 8 very briefly, what it means is we have all the bits in place to achieve what we need to achieve over the medium to long term. The work that's gone in over the last couple of decades is there and good to go. And for us, the big opportunity, if we go onto page 9, the big opportunity is we're relatively mature in the UK. I still think there's further opportunities for growth via market share gains, but the big opportunity in the short to medium term is in mainland Europe. 35% of our revenue in FY24 was from international sales, predominantly mainland Europe. It was up from 30% the year before. We expect in FY25 that to be more like 40 to 45%. We have had a plan in place to grow in Europe, but plans are plans, and many investors, not unreasonably, have said to us, until you can show that you're delivering on that plan, we're going to keep valuing you as a UK cyclical, which I do understand. FY25 is going to be the year when we will really start delivering on our European ambitions in terms of growth and revenue. But it is only just a start, and I'll talk about this a bit more as we go through the presentation. So, page 10. So we have the strategy for Europe is really quite simple. We're going to market ourselves we are marketing ourselves in 2 ways. The first thing we're going to do is we're going to market our brands on the Amazon EU platforms. Now, the logic there is really simple. Amazon is the biggest GM retailer in Western Europe. If we can use the brand building tools that are within Amazon's marketing toolkit, and they are very effective and particularly cost effective, and we can drive awareness of those brands on that platform in those territories, it will drive wider awareness of our Salter and Beldray brands. So that's the first way that we plan to market ourselves into Europe. The second thing we plan to do is market our capability by being the most effective supplier to our current European retailers. We're not exactly new to Europe. We have we serve retailers such as Kaufland in Germany, Lidl, which is sort of pan-European, Biedronka in Poland, and of course Action. And Action is going to be, we feel, of particular importance in terms of marketing our capability. These are hugely credible retailers, and as other European retailers see what we're doing in these other accounts, then that will, we believe, drive those retailers towards us. We have our European showroom in Paris to greet them with, and we have an account management team there. And I just possibly Action being the more important one of that group. Action is really a retailer that other retailers follow very closely. So we have a 5-step plan for marketing our capability. We're going to have products that some of them are pretty straightforward. We're going to supply products that sell through, of course. We're going to be the best supplier for quality, which is of ever increasing importance. We're going to help retailers manage their inventory, which is a service that very few suppliers offer. We're going to be the most responsive in terms of account management, and then we're going to market our successes when we do well. Okay, I'm going to come back a bit later on to talk about outlook. I'll hand over to Chris to talk about the FY24 numbers.
Thanks, Andy. So obviously, disappointing year with revenue down by 6.5%. As Andy mentioned earlier, there had been a period of 2 years where most retailers were overstocked. We started to see the end of that in FY24, and the major component for us was our German supermarket customers remained overstocked. In FY23, some of that overstocking was compensated by the air fryer boom that we saw. Now, the air fryer boom was fantastic when it happened, and we thank Martin Lewis for that. We've been selling air fryers for a number of years at sale levels of about 5 million. During FY23, they jumped up to 26 million, which was fantastic at the time. But with all booms, you know that they are going to start coming down. So in FY24, they came down to about 15 million. So that was a 10 million headwind to us. And that was especially in the first half of the year. When we started January 24, so halfway through the year, we came back with quite a lot of positivity, because we thought we'd got through the headwind of the overstocks. We got through the sort of like the hard comparatives in relation to air fryers. And we were starting to think that the UK consumer would start spending again. So the UK consumer had gone through a difficult period with the cost of living crisis. And by the time we got to January 24, people were starting to see their real living wages go up. So they had more money in their pocket because inflation had come down and salaries were going up again. Now, what's been really odd about the whole of FY24 is that the UK consumer has not been spending. There's been a variety of reasons given for that during the year. For the first 3 months, it ended up being the weather in February, the weather in March, the weather in April. That starts to wear a bit thin. So then the excuses went on to the election uncertainty. And then in recent time, it's actually moved on to budget uncertainty. Now, I think one of the things is nobody really knows why the UK consumer at the moment is choosing to save more money than to spend. Various different reasons have been given about interest rates or rebuilding balance sheets or nervousness. There probably hasn't been enough research to give a definitive answer. And it is certainly true to say at the moment that softness that we saw in the UK consumer has continued into FY25 at this moment in time. We are starting to see some very early signs of green shoots as we move into peak, but we really do need to see the consumers starting to spend more, and we hope for that over the sort of like the peak trading season over the next couple of months. Looking down in relation to gross margin remained remarkably steady at 26%. Now, some of you who follow us will have known that we've been speaking about freight rate rises quite a lot this year. So freight had a proper crisis a couple of years ago where rates went up to $18,000. So it's a bit more of a mini crisis that we've had this year, which has been caused by the Red Sea being closed, with freight being diverted around Africa instead. So that did cause shipping rates to spike over the summer. Now that didn't hit our margin during FY24 because during that peak is when we were shipping it over but hadn't sold the goods yet. So what happens is you inventorize that and it goes on the balance sheet in stock. So that higher freight rate is actually going to hit profitability in the first half of FY25 when those higher shipping rates come through. Now we do know that that is a one-off effect, because what we've seen is shipping rates rose very high during July and August. They have come back down now to a normalised rate. So that increase and decrease, that sort of like triangle, is about 2 million of excess sort of like freight costs that we will see coming through our income statement. As Andy has alluded to, admin expenses flat during the year. That's despite us having wage inflation and other cost increases, but we have squared that circle through our drive in relation to productivity, and that can actually be seen in the stat just above. That despite gross profit going down, our gross profit per employee is up 4% to 118,000, which reflects the success of our efficiencies. So just moving on to slide 12, we've got a very detailed breakdown of revenue here. I'm not going to go into all of these because you can get absolutely lost in all the detail. I think there's probably just two things that I want to pick up on there, is that firstly, Europe being up 7%, and that's despite having overstocks with the German supermarkets. And that's because we've seen a large amount of growth from European discounters in the year, and we expect to see that level of growth continue into FY25. The other positive, which is probably more of a one-off, is in relation to our clearance division. Now, the clearance division is actually the heart of UP. It is where we started when Simon Showman founded the business. It was dealing with closeout packages. The overstocks that we saw were not just at retailers, they were at brands as well. So during a year where there were overstocks, which hit our branded products as well, there were abilities to buy some closeout packages and sell those on. So this actually shows the resilience of our business and the way that we trade incredibly hard to counter the weaknesses that we were seeing in demand. And in some ways, that clearance is a counter-cyclical thing. So when there are overstocks, there are more opportunities for that clearance division. So we would not be expecting to see as many opportunities there for that as overstocks have ended, and there are more opportunities for the rest of our brands to be sold instead. So on page 13, I've tried to sort of like simplify what sort of like happened in relation to revenue, to not have the complicated table, but to simplify it. So you can see there the big 11 million headwind in relation to air fryers, the headwind in relation to German supermarkets, which has now come to an end, and then showing that all of our other sales put together up by that 6.7 million. Moving on to the bottom end of the income statement. On slide 14. So adjusted EBITDA down 11% to 18 million. Then further down, depreciation amortization relatively flat. The finance expense up due to interest rates being higher. So we previously had some wonderful caps and swaps, which we took out when interest rates were at 0%, which had held back our interest charge. Obviously, all good things must come to an end. We had those for a period of time. They've come off, so we are now seeing a higher effective interest rate on our finance expense. The tax rate has gone up in the UK from 19 to 25%, meaning that the tax expense up 7%, despite sort of like PBT falling, which has left our statutory profit down by 16% to 10 million. Now moving on to slide 15, as Andy said, we have decided to maintain the dividend. So our policy is and will continue to be to pay out 50% of our profits, which would therefore indicate the dividend should have gone down by 16%. But we decided to maintain it, and there's two reasons for that. First of all is that we have a new capital allocation policy, which is aiming for a 1x EBITDA net debt. At the end of the year, our net debt was at 0.6x, so we have plenty of headroom within our capital allocation policy. So there is that thing of returning more cash to shareholders. So therefore, we maintain the dividend for that perspective. And it's also because we have confidence in the medium-term prospects for the group as well. So we maintain that dividend at 7.38p. So moving on to the balance sheet, slide 16. Now, the balance sheet has remained remarkably stable overall. So, fixed assets stable, working capital stable, accounting assets relatively stable, net debt obviously down due to the profits that we have made during the period. So I think the one thing I want to bring out is a couple of those movements in the working capital. So you can see there that stock is up by 8 million. Now that comes down to the shipping crisis. So one of the things that happens now is that the ships aren't going through the Red Sea Suez Canal, they're going around Africa. So that's added a significant amount of time, which means that we have more stock on the water because it is taking more days. So in the prior year, we had about 5 million of stock on the water at year end. This year, it's up to 15 million that we had on the water that we were importing into the country. Now, obviously, within that and within that sort of like stock balance, we do have that 2 million of the excess freight charge, which obviously that has gone in there and that will flow through the income statement during H1 25. So just moving on to slide 17, you can see there how net debt has moved. So we went from 14.8 million down to 10.4. So, 0.6 times debt to EBITDA ratio. So well within our sort of like 1x capital allocation policy. So you can see there some of the uses, not very much investment in working capital on a net basis over the year. I would be expecting as we grow in Europe and we grow with our European discounters that we would be expecting to see investment in working capital. And that's why we do have quite a lot of working capital facilities. So in total, 37 million of facilities that we have with HSBC, which is to fund working capital. Obviously, we did start a share buyback process during the year as well, along with the 1x EBITDA. So at the moment, we're doing that at a level of about 1 million per quarter. But that could go up and down depending on the working capital requirements of the business. So that is a flexible item. So Andy, handing back to you for the outlook.
Yeah, I think we're on page 18. Thanks, Hannah. So obviously it's very early on in the year. We're just at the end of Q1, and we do have the kind of crucial sort of November, December period just ahead of us. There are, I would say, three major factors influencing the performance this year. One of them is known already, and Chris has talked about it, which is the 2 million additional shipping costs, which will go through the P&L in H1. We don't see the circumstances around this recurring next year. I think there's a particular set of circumstances for this year. So we do see this as a sort of known one-off hit. Obviously very disappointing, but we were certainly one of the very earliest businesses to highlight this issue back in the summertime. The second factor is UK demand. Again, Chris made reference to this before. It has been particularly soft during this calendar year, somewhat unexpectedly, because consumers were expected to use their spare cash to spend, and they have in fact used it to save, which is certainly an unexpected outcome. I mean, in my lifetime, certainly consumers have tended in the UK have tended to spend rather than save, and I think your view and I have my view as to how this is going to play out, but you may well have your own views as to how this will play out. My view is it is going to be a headwind in Q1, H1, but we do think UK demand will firm up as we move through the second half of our financial year. We've seen some very early green shoots in terms of demand through what we call our near-term business, like our online business, through our call-off business, and through accounts which tend to order more hand-to-mouth. So there is some very early green shoots. But having said all of that, November, December will be critical, I think, in signing the direction of travel for calendar year 25. If the consumer doesn't spend in November, December, they won't be spending in Jan, Feb, March. That's just a fact. If the consumer comes out over the next couple of months and they run to Christmas, then there's a decent chance that momentum will continue into calendar year 25. I say our view is that there will be a modest firming up of demand. No one's expecting some sort of consumer boom. But you may have a different view on that, and I think that view will be informed by what happens over the next couple of months. The third factor, again, we've touched upon it already, is our European growth. We are seeing strong growth in H1, but we are seeing accelerated growth in our order book for H2. With our European customers, we get more visibility because they order further ahead. So that order book for second half is helpful in terms of that visibility. But yeah, strong growth in H1, accelerated growth in H2. And I think for me, what's really exciting about this, the shipping, the additional shipping costs, and the softness of the UK consumer. It's these are FY25 issues. The growth in our European business we see as an FY25, FY26, FY27, FY28 trend. We do think that the strong growth we're seeing accelerate through FY25 will continue on into future financial years as well. And that for me is hugely exciting because as a cyclical consumer goods business, UK focused cyclical consumer goods business, it's going to be very difficult to deal with the headwinds of escalating wage costs, and that's not just us. That's everyone in our sector, whether they're on the retail side or the supply side. And I don't want to refer to individual names, but there've been plenty of examples of that in recent weeks and months in terms of people's announcements to the market. We have two ways to mitigate that. First of all, as I said before, our relentless focus on productivity, which has already proven itself in terms of mitigating those headwinds. But secondly, our ability to find different markets, go into Europe and find additional volumes from a market where we're still, in terms of market share, incredibly low. And just linking back to the point on the automation, I've talked a lot about how the automation has mitigated the headwinds that we've had to our cost line. But actually, we're going to see the big benefits as we grow our top line. It means that as we grow the top line, the increase in our cost line should be relatively modest because of the automation that we've introduced into our processes. Okay, I hope that was useful to you all. Hannah, I think it's time for Q&A.
European sales reached a peak of 39% in the back of turnover in 2019. What are the challenges in trying to return to this level and beat it on a consistent basis?
Well, I think I've probably answered that one. I hope. We do see that share going to 40 to 45% in FY25, and very much kicking on from there. And we do think in a couple of years, we'll be a majority non-UK revenue business.
Thank you. What steps will you be taking to mitigate the effects of the budget? You've had 24 hours, Andy.
Well, maybe we've had more than 24 hours because I think the increase in NI has been well flagged. Chris, you've done the. You need to.
Back of the fag packet is sort of like it's about a 400,000 hit to us. But as a business, we have been seeing sort of like wage inflation and cost increase over a number of years. So the way we mitigate that is through our continued productivity and the continued work that we're doing that, which has meant that, admin expenses were flat FY23 to 24. I'm still expecting them to be flat 24 to 25 because we will continue to invest in our productivity.
Thank you. Just back to Europe. Do you expect German sales to recover to their 2022 highs in the medium term? I think that's a specific country focus there. Or are there more fundamental issues with that market?
No, the decline was down to the overstocks, which did take longer to clear in Europe and Germany, more specifically. So no, we do expect to see a recovery in that market. I would just say though, when the kind of retailers that we're targeting are typically have a pan-European footprint. We're not looking to replicate what we have in the UK, which is an offer where we serve retailers from the from Tesco all the way down to very small individual retailers. We are targeting the very large retailers over in Western Europe. So it may be that we will continue to analyse the revenue over there between France, Germany, etc. But it's the European segment as a whole and the revenue that accrues that which will be more relevant going forward if that helps.
Okay. Again, Europe. When you opened your showroom in Germany, the sales jumped, but growth did not continue. I think you've just touched on that. But now you've moved to France, French sales have jumped. Do you expect the French growth to continue?
So the best way to think about our showroom is not as a French showroom, as our European showroom, and that showroom underpins a European business that's already a 50 million revenue business. So that's the way to think about it. I mean, so really what we did is we didn't close our German showroom and open a French one. We moved our European showroom to Paris, and we moved there to Paris for a few reasons. First of all, in Germany, the retailers there at post-COVID versus pre-COVID were less willing to visit showrooms. They prefer now you to visit them. whereas in France, it's still very much the culture of people visiting showrooms. The connectivity in Cologne degraded post versus pre COVID, whereas the showroom, the European showroom where it is now, 15-minute taxi ride from Charles de Gaulle, is really accessible both for our people who can literally travel out in the morning and back in the evening if they need to, but also for our retailers across Europe, for whom Paris Charles de Gaulle is much more accessible than Cologne.
So the biggest orders that we have written in our Paris showroom have been to a Dutch customer. So it is not that it is only about selling to French customers. It's about selling to everybody and having that accessibility of a showroom to see our beautiful products to all European supermarkets and discounters.
Thank you. Can you expand on how you plan to attract European prospects with inventory management? Is it mainly greater timelines, or do you mean things like clearance as a service too?
So what we really like with a retailer is we really like data. We want their sales out data. We want their inventory data. And most large retailers are very happy to share this with you. One or two are a bit reticent, should we say? But in the main, large retailers are happy to share this data with you. Now, I think once we have this data, we've got a load of tools that we developed internally to analyze this data, and then contributes, because I think that often the problem for retailers is they don't have the resource, and maybe to some extent they don't have the tools in order to do the analysis work that we can do. So what we want to be, we want to be the sort of stock planner's right-hand person, taking their data, dropping it into the tools that we use to analyze it, and then be able to go back to that stock planner and say, look, you may not have noticed because you're managing hundreds of lines, but this particular line is selling well, and if you don't reorder by this date, you're going to end up with an out of stock. Alternatively, we are, I think, one of the possibly the only supplier that will do this, is possibly it may be that the line is selling more slowly than was planned. At that point, we'll be wanting to speak to that stock planner and that buyer to say, look, this isn't going as well as we hoped. Let's maybe plan a promotional period. We might offer to make a financial contribution to that, and see if we can find a way to accelerate the sales back to the levels that were acceptable. Or maybe even say, and we really are the only supplier that does this, say to the retailer, look, you've got another purchase order coming in on this. Why don't you let us delay that purchase order till you're... So it's all this kind of stuff really, which we do, that other suppliers don't do, and they don't do it for two reasons. First of all, they maybe don't have the tools to do it, and secondly, the idea of a supplier saying to a retailer, order less, is a bit kind of culturally difficult for lots of suppliers. Now, to be fair, FMCG suppliers do this kind of stuff all the time. It's not something that's as common on the GM side, but on the FMCG side, it's actually a kind of core skill set. So that's why we're delighted to have Andrew Milne joining the board from an FMCG background, and Jose Carlos joining the board from an FMCG background as well, because we do think there's lots for us to learn off top quality FMCG suppliers.
Okay, thank you. Two questions here on Petra, which almost mirror each other. Are the big hopes for its future dashed? Where do you see it now? Will it ever be on a par with Salter and Beldray?
So Petra is, we did make a decision earlier in the year to really double down on our focus on Salter and Beldray. If you look at where the growth has come from last decades, the key drivers have been those two brands. So we really want to kind of focus our investments, our attention, our marketing on those two brands. You will, however, see, I think, Petra grow into a fairly significant brand over in Europe. Even though we need to have our focus on Salter and Belgrade, you always need some plan Bs. Because sometimes, most of the time, that's what's going to work. But sometimes, for whatever reason, it could be channel management. It could be another reason where the retailer, for whatever reason, doesn't want to have the same product in their store as other people. You want to have a plan B, and we have some tremendous plan Bs. You know, we have Progress, which is, you know, a Lancastrian bakeware brand, dates back to 1930s. We have Clean Easy, over 100 years old as a brand, and we have Petra, which is a Bavarian, originally coffee brand, which was created in the 1960s. So I think we will see Petra grow, but it will be on the basis really of our main focus is going to be in Salter and Belgrade. Oh,
you're on silent.
Thank you. I said let's stick on that theme. So it's clear that some obvious good work with the Salter rebranding, which we can see in various retailers. I was surprised to see a decline in branded sales and a strong increase in own label. What were the reasons for this, and when do you expect to see the benefits from the rebranding?
I mean, Salter specifically as a brand, it's in relation to air fryers, because we sold most of our air fryers, well, 99% of our air fryers were sold under the Salter brand. So really that is an air fryer story. And the clearance, I think I spoke about it quite a bit earlier. The clearance is our closeout business, and you know, when there are overstocks, and overstocks mean that it is more difficult to sell our own branded goods. The flip side of it is, because there are overstocks within the whole of the ecosystem, people are trying to get rid of them. And that's what we can do in our closeout business. Because we have multiple different channels that we're selling through, because we have relationships in different countries, we are incredibly useful for doing that. So what we can do is take a closeout parcel from a German supplier, and we can clear it out to UK retailers. And actually that's been incredibly useful this year, because it's opened up some doors with new accounts. So there's one UK supermarket chain who we have not been working with for a number of years, but we've opened the doors there with selling that closeout. But now we've got through that closeout, they've gone, oh, you know, you're great, we like your capability, and now we're moving them on to selling our own branded products there, because you don't want that clearance to become a large part of your business, because you know it does eat into your own branded goods, and what we want to grow ultimately is the branded side of the business.
Okay. Will there be a material difference in the Salter and Belgrade brand management and rebrand process in mainland Europe versus UK?
No, I don't think so. I mean, it's possibly a question better answered at the interims. We're in the process of what I said before about marketing our brands, particularly Salter and Belgrade, on the Amazon platform. We're in the process of writing up the marketing plan for that. So it's a great question. My initial response is probably not. But Tracy is going to be presenting to the board in January on her plans for marketing Salter and Belgrade in Europe via the Amazon EU platforms.
Okay, thank you. Question here around the effects that you have seen from the Temu effect and their offering. Is this having a material impact on yourselves?
No, it's not, but it is a threat that does need to be taken very seriously. You know, there's the product on the Temu platform is very cheap, but it's very cheap, frankly, because a lot of the time it doesn't comply with UK regulations, and this should be a source of huge concern for government. We've there's a lot being put on businesses at the moment, like yesterday, and that's fine, and we got broad shoulders. But the quid pro quo is the government has to ensure a level playing field for we're paying employers NI, well, the suppliers on Temu aren't. We're paying packaging taxes, suppliers on Temu aren't. We're complying with UK regulations, workers' rights bill, people on Temu clearly aren't. Now, obviously, the wheels of government regulation turn very, very slowly, as we all know. We're making representations along with other people in our industry on this issue. In the meantime, it really reinforces the importance of focusing on our brands. Going down an unbranded route, and we get asked all the time to do own label. That's the part that's going to be most exposed to the threat of Temu. We know from our market research that the consumers want a brand when they buy general merchandise. They want that. It's often different with food, where a retailer brand can be, particularly a grocery brand can be just as attractive to them. But we know the brands really count when it comes to the consumer. And all we can do in the short term to counter the threat of that is to double down on our brands, particularly Salter and Belgrade.
But I think what's terrible about the situation with Temu is it probably is going to take a human tragedy to get government to move. I mean, almost with this, it's like, okay, fine, you buy a T-shirt for 99p and it doesn't fit, you throw it in the bin. What we're probably now going back to is, the 1970s, where people were sort of like dying because their Christmas tree lights set on fire and set their house ablaze. What we're moving to now is people buying things which could risk their families' lives because they are dangerous, substandard, and therefore, the plastics that you're using in your power pack, if that power pack sort of like fails, that plastic should not burn. Whereas if you're seeing kind of like cheap replacements, they aren't just sort of like going to cause a problem like, okay, it looks rubbish. It could actually be kind of like causing danger to your home.
We've seen some of this already with e-bikes, haven't we? People putting e-bikes in their hallway, and maybe not from a decent brand, and then the battery. Batteries are really dangerous if they're not produced properly. This you wouldn't put a can of petrol in your hallway, and yet you've got an equivalent amount of power stored in that battery, and then of course you're leaving it in the hallway, which is your fire exit. So there's if you look at the if you Google Daily Mirror Temu toys. You'll see an article last week where, according to a study, a review that they've done, 80% of children's toys bought off Temu don't comply. Children's toys, we're back to the 1970s, and I remember lead painting in kids' toys. It's, and I think the difficulty is, Hannah, that we have become used to the fact that what we buy is safe. We didn't always take that for granted, but people are taking for granted that what they're buying off certain platforms is safe. And I think people need to be more careful, in my opinion.
I'll send Panorama around to have a chat with you, Andy. How long is the lag on freight prices, both up and down? And do you use spot prices or some form of hedging?
So we've already the crisis is behind us now. So it is the mini crisis is behind us. It's when we last updated, it was still a variable. We were predicting that it would come down in time for about November. Thankfully, our predictions were correct. I did have my fingers crossed, I must admit. In fact, the freight rates have come down more quickly than we expected. So it's a known quantity. It's £2 million, and it will be going through gross profits in H1 of FY25.
Okay.
But just on the specific question about the lag, normally for us it's about a lag of 3 months. So it's about the working capital cycle that it takes between peaking and it starting to come through our income statement.
On the hedge point, we do enter into certain fixed contracts. Shipping is an unusual industry, shall we say, in that you can contract to certain rates which overnight disappear depending on what's going on in the general market. We hedge our interest rates, we hedge our currency. There is no really effective hedge on freight, unfortunately. We have to roll with the punches.
And we do, of course, watch spot and what is happening to that the whole time. But probably the important thing to go is that we rarely pay spot, and most people rarely pay spot because most people have some sort of like contracts going ahead. So it's only at the sort of like the margins that you end up paying the very high spot rates.
Okay, understood. Thank you. Can you explain the reasons for markedly high year-end inventories and payables, and explain how this unfolds in FY25?
So I think I've gone into that in terms of it being the stock and the freight. So given the fact shipping times have extended, so that has caused stock to go up. So probably not any point to go doing it.
Probably covered that one. Yeah. Online sales after a down year in 24, when are they expected to hit the stated target of 30%?
So I think that it was a disappointing year. Obviously, we grew by 60% in FY23. An element of that was air fryers. Probably as a channel, online was the biggest beneficiary of air fryers in 23. So there was a correction in FY24. I think that I suspect FY25 will be flattish on online, and will return to growth in FY26. In terms of when it'll hit 30%, I think that's going to be quite a difficult one to answer. Not least because of what might happen with our international revenues, which will be largely retail focused. So I'll come back to you on that one.
As long as the pie is growing.
12 months time.
Good. Well, that's it for the questions. So thank you both very much for your time today. And any closing remarks?
No, just to say thanks to everyone for the time. We do, Hannah knows I'm very fond of our retail base. I do like, we really do value the engagement and the interest which everyone shows in UP. So thank you all, particularly the holders, but the non-holders as well for being on the call.
Absolutely. Well, we look forward to further updates. Thank you both.
Thanks.
Thank you.